Hello and welcome. Today we're going to look at the SCHD ETF, Charles Schwab US Dividend ETF. I'm going to tell you why you need to invest today in order to get a great rate of return in this market downturn, and you can average into the market over the next few months or just put a lump sum in now. I think you'll make a lot of money going forward. So let's get right into it. What this ETF does is track the Dow Jones US Dividend 100 Index, the MER 0.06, $6 for every $1,000 invested, $60 for every $100,000 invested, and think of that compared to the 1% a bank might charge you to manage your money. So you get instant savings right there, and it's passive income. At the end of the September quarter, 3.7% was the yield on the holdings they had. What I like about this is the average market cap is $109 billion. These are the biggest companies in the US market, and there's 103 of them overall in this portfolio to spread out the risk. Just in case one of the large names ever went under, you'd still have 102 companies left. So if you like what we have to say, please like and subscribe so you'll get notified of any future content we post. Starting with the top 6 sectors, information technology got beat up, but I think it's a good time to be buying into that. Financials also beaten up, but those are going to be the 2 biggest sectors of the economy going forward. Then you have your staples, which are things like grocery stores, things we need to buy regardless of a recession, an expansion, and with inflation, it's a good way for you to kind of combat it. Healthcare and industrials make up number 4 and 5 with discretionary. And again, so you know this is very broad based, not overweighted in one sector versus the other. So you will do well. The 10-year numbers were great, 12.1%. Yeah, you might be negative in the last 12 months. However, 3, 5, and 10-year numbers look very respectable. And if you're getting double digit, even if you're getting high single digits, I think those are great returns because we can only do what the market gives us, but this has kept half the downside of the market. So it's good to preserve capital. Price earnings ratio of 13.4. That is very cheap. Historically, the index for the S&P is 15 to 20, but these are, again, are the lower volatility stocks with earnings growth as opposed to companies with no earnings at all. So that's how you're going to feed your dividends going forward. Price to book 3.2. Again, very solid number, not expensive. And when you're looking to buy low, sell high, I mean, this is not expensive at all. We're on the lower end, and even if it tails downward for the next little while, we'll be okay. This ETF invests in stocks selected for fundamental strength, dividend history of long term. So you can't just start a dividend and get in. You have to show the history and financial strength on your ratios. You'll see the usual suspects: Broadcom, Verizon. Hey, we're addicted to cell phones, data, internet, mobile, computer chips. That's the place you want to be. Pfizer, Merck, your pharmaceutical companies. Guess what? We have an aging population. We're always going to need medication. Lockheed Martin's in between Coca-Cola and Pepsi. So Warren Buffett loves a lot of these stocks. Can't go wrong if you're agreeing with Warren. So Pepsi and Coke, you've got the top 2. Snack and drink manufacturers. So market is cornered. Cisco, Home Depot. Home Depot had a nice boom during the pandemic. IBM, you're back to the technology side. Very broad-based. Again, you spread out the risk by having these companies. If Coca-Cola went under, we'd still have Pepsi. So guess what? Your money would be safe, I think. And they have a history of paying and raising those dividends, which is just like the best of both worlds, I think. You're not going to be a millionaire overnight, obviously, but this is a marathon, not a sprint. What we're going to do is go into the last year. Obviously, you see negative 7-8% on this, which isn't too bad relative because the market fell by 20%. So I'll take this number because in the bigger picture, 5-year numbers, you had something that was $52 is 50% higher now. You're basically getting your double-digit return or very close to it. And when this ETF came about in 2011 in the fall, was worth about $25. It's worth $75. And throw in all the dividends you've been getting, you've done very well across all markets. Tail end of the European debt crisis, debt ceiling debate. We had some expansion, oil crisis, COVID right here. And you know what? I'm okay if it goes sideways. You can't go up forever, but if you extend this the next 10 or 20 years, you will do very well. Thank you very much. And again, please subscribe to stay tuned for more of our